Hello, left fielders. At LFI, you know our focus is on networking and education. Mark your calendars because we're going to have a full day of it dedicated to you, our limited partners, at the Best Ever Conference on April 9th in Salt Lake City. LFI is opening the BEC with Passive Investing with Left Field Investors, an event focused on passive investors. This will be where insightful content meets passionate limited partners. If you enjoyed BEC last year and the meetup in Left Field this year, then imagine them both back to back. The Best Ever Conference isn't just any event. It's the premier conference for commercial real estate investors and operators. Your ticket to Passive Investing with Left Field Investors includes admission to the entire Best Ever Conference from April 9th through the 12th. Join us April 9th, where we will have a packed agenda with sessions focused on how to be a successful limited partner, led by experienced LPs, top operators, and partners. Then, immerse yourself in the full Best Ever Conference, where you will be surrounded by like-minded investors, operators, and industry experts for unparalleled opportunities for learning and networking. The best part, and there are so many, but the best part, you won't find a bigger discount on the regular ticket price than the one you get for being an infielder. That's more content for an exclusive lower price. Register for the event today at leftfieldinvestors.com/BEC, and we will see you at Passive Investing with Left Field Investors at the BEC. Are you looking for a way to invest at a lower minimum and participate in more deals? Look no further than our weekly deal webinars hosted in collaboration with TribeVest. With every deal we offer, Left Field investors have the option to join an open tribe, allowing you to invest for as little as $10,000. No need to meet the standard $50,000 minimum. Joining an open tribe is easy. TribeVest handles all of the setup, fund collection, and distribution, and even provides K-1s for tax time. All you have to do is sign up. Stay up to date with LFI by subscribing to our emails and gaining Clubhouse access to join our deal webinars and open tribes. Don't miss out.
90% of people don't read the PPM, and 95% don't do deep dive due diligence. My friends, this is why you need to listen to my friend, Jim Pfeiffer, and go out and do the deep dive due diligence. Doesn't seem like it's that important when the tide's rising and everybody's happy, but when the tide's going out and people are starting to swim naked, as Warren Buffett says, you don't want to be one of those, and you definitely don't want to be investing with one of those guys.
Hello, left fielders. Welcome to the Passive Investing from Left Field podcast. Our community is focused on networking and education to help people invest passively and think differently. Let's go.
This is Chris Miles, and you are listening to the Passive Investing from Left Field podcast.
I am thrilled today to have Paul Moore with us. He is the founder and managing partner of Wellings Capital, a real estate private equity firm. He's the author of several books, a regular contributor to Bigger Pockets and the Real Estate Guys radio show, and a guest on our show for a record-tying third time. So check him out. Check him out in previous episodes 24 and 81. They were, I think, 2021, 2022, and now we're hitting it up for 2023. So we just got it in at the end here. Paul, welcome again to the Passive Investing from Left Field podcast.
So great to be here. Thank you so much, Jim. I hope we have some fun today.
Oh, I'm sure we will. We did the last couple of times. So the first question I always ask is about your journey, and I understand we've already covered this in episodes 24 and 81, but we want to, in case we have new listeners, we want to do that again, but maybe give a little bit of an abridged version so we can then just dive right into it.
Yeah. I started out with an engineering degree, which was a huge mistake. Then I got an MBA at Ohio State, which was not a mistake. And then, yes, that's right. And anyway, I worked at Ford Motor Company 5 years, had my own company 5 years, sold it to a company from Columbus. In fact, they were a publicly traded company in 97. Thought I was a full-time investor and I was more of a full-time speculator. I didn't know the difference, made tons of mistakes, and that helped me a lot when I started my podcast called How to Lose Money. And we had that show for 4 years, and we had a lot of fun. Along the way, I became a multifamily syndicator, did a hotel, and then I actually put the brakes on multifamily syndication because I really felt like it was getting out of hand as far as overpopularity, overpriced, overleveraged, all that stuff. And by the way, just to be super clear, that doesn't mean a lot of folks did this perfectly, and we still invest heavily in multifamily with the guys who do it perfectly. I was not a good multifamily syndicator. We were not getting the deals they were. We didn't have the property management, asset management. The 80-20 rule says, you want to be in the top 20% of operators, and we weren't anywhere near that. So we pulled back and started a fund, and we go out and look for those top 20%. We invest heavily with them, and they do the heavy lifting. So like you said, I've written 3 books, and we're on our 6th fund now. So that's a quick history.
That's awesome. I want to jump into one thing you said. You said you were a speculator, but you didn't know it.
Yeah.
What does that mean? Can you talk? I've kind of finally figured out after, a lot of years in finance and real estate that, I also used to be a speculator, and now I'm an investor, but I'd love to hear what that means to you. What do you mean you were a speculator, and how has it changed?
Yeah, the quick way of saying it is speculating or investing is when your principal is generally protected and you've got a chance to make a profit. Speculating is when your principal is not at all safe and you've got a chance to make a profit. More specifically, I think investing is when the value of the asset and the more importantly, the cash flow from the asset determines the price. Okay? As opposed to speculating where it could be anybody's guess what the value is. It's just the greater fool theory, musical chairs, whatever you want to call it. And if you think back 25 years to the dot-com bubble, everybody or the smart investors like Buffett were saying, this is crazy. I'm not going to invest in internet tech stocks. I don't know where the internet will be in 10 years. I will invest in Wrigley's chewing gum because I know how people will be chewing gum in 10 years. And people laughed at him, mocked him, said, he's 69 years old. What does he know? He's an old fogey. And of course, he was right. And now he's 93, and people still know he was right about that and 100 other things over the years.
That's great. That's a great definition. I've kind of come up with my own, not my own, but how I look at it is, speculation is where you're buying an asset, usually a paper asset, and then hoping later you will find someone else to buy it for more. While investing is where you're investing in something that's going to provide you with a current benefit, usually in the form of cash flow, and then maybe it'll appreciate as well. But I love how you added in that, investing is where your capital is relatively safe and speculation is where it's not as safe. So I think those are good distinctions.
Right. Thanks, Jim. Yeah, I think that's a really well said, what you said as well. So that's great. I love it.
I love it. Okay, so now I want to dig in. We're talking about preferred equity today, at least to start out, because that's becoming more prevalent and people are talking about it. So let's start off. What is preferred equity, and why do I get it confused with preferred returns?
Oh, yes. Well, I'm really glad that you brought it up that way, because if you're listening right now and you think, oh, yeah, I get preferred returns as part of my investment with any number of syndicators or funds, this is not that. This is something completely different. A few weeks ago, Multi-Housing News had a headline that said, preferred equity is pouring into multifamily. The tried and true financing tool is having a resurgence. In fact, 2 days ago, I talked to a guy in Manhattan, and he said pref equity is the prettiest girl at the dance right now. So today we're going to talk about preferred equity, what it is, what it isn't, what the risks are, what the benefits are, why we're excited about it. Preferred returns as part of your investment is just a hurdle rate. In other words, the GP or the syndicator or the fund manager says, hey, since you took a risk, since I know more about the deal and you brought the capital, I'm going to give you the first crack at getting a payout. You're going to get let's say 8% preferred return. And then only after you get 8% a year do I get paid as a GP. And so that's preferred return. Preferred equity is something totally different. Does that make sense, Jim?
Yeah, it does. And I wanted to come out with that clarity because, it is confusing. There's so many terms in this industry that are similar, but they mean totally different things. So Today, we're going to be focusing on preferred equity and what that is, how you invest in it, and all that. So now that we've got the preferred returns out of the way, which I appreciate, what is preferred equity?
So preferred equity, it sits in the middle of the capital stack. So if you can picture at the bottom, imagine a 3-part stack, okay? At the bottom of the stack, in the senior position, is the senior debt. And let's just say, imagine that's 60% of the stack, okay? And now imagine, let's jump to the top of the stack. That's common equity. And you would think that would be 40% of the capital stack, 60 to the debt, 40 to the equity. But in these times, it used to be you could get 75% debt and then you only had to raise 25% of the equity. Now the lenders are coming back saying, hey, we only want to give you 50, 55, or 60% debt. And it's harder to raise equity, a lot harder right now. So that's leaving a gap in the middle. So picture our stack with a new gap inserted in the middle. And let's say it's 60% debt, 25% equity. And now you've got this gap, and this gap has to fill that, and that would be 15%. That preferred equity sits in priority ahead of the common equity, but behind the senior debt. Preferred equity is like debt in that it has monthly payments. It's like debt in the sense that sometimes you can get the operator to sign a personal guarantee or pledge some of their assets, but they don't pledge this asset because the senior lender usually wouldn't, allow that. So the senior lender wants to be, typically the only lender in the deal. So there's no lien. And so it's like debt in some ways, but it's not as good as debt because it doesn't have a lien on it. Where it's better than debt, or different and better, I hope, is it's got upside. And so it's equity. It's got debt-like returns, but equity-like upside. Somebody said that. And if you're listening right now and say, this sounds really dangerous, it can be really dangerous if you don't do it right. And it can be really bad for the common equity holders. And hopefully, Jim, I'll remember to circle back to that because I don't want to run out of time here. So pref equity sitting in the middle of the capital stack, like I said, it gets cash flow. Typically, we're seeing cash flow right now in the range of maybe 8, 9, 10%. And then it's getting equity-like upside in terms of maybe 4, 5, 6, 7% upside. And so the total returns on some of the pref equity deals right now can be in the range of, something like 14 to 18%. And if it's a development deal, ground up development, much higher in some cases. And so it's structured for immediate cash flow, future upside, shorter hold time, higher payment priority, lower downside risk, still receives depreciation tax benefits if they're negotiated. There's a potential to negotiate management control rights, forced sale rights. You can actually reserve the cash up front. For example, we invested in a deal where we reserved the whole year of cash flow up front. So let's say it was 10% cash flow on a $5 million investment. We took $500,000 cash up front at closing, and we put that in a reserve account that we controlled. And so it's sort of like a lender that takes, they do cash management. And you sometimes can negotiate a minimum total return in case you're taken out early by the operator. The reason it's good for the operator at closing is if they have a value add deal and they got this gap I mentioned earlier, the operator can sometimes do the value add work and then pay you off and take the pref equity out in say 2 to 3 years. And then if they paid for that takeout on their own, they own that big piece of equity. Or if it's used, if it's done through a refinance, the whole equity group now, instead of getting 25% ownership, now they have, in my example, 40% ownership. And so a lot of benefits to everybody. The risk, of course, is to the common equity people who now are pushed further out in priority. And if things go south, they'll go south faster for the common equity people. And so I'll take a breath. What questions do you have, Jim?
I got a lot. Just for clarity, when we're talking, you said you're using terms like senior, the debt is senior. That just means in a liquidation event, the senior debt, that's the debt from the lender, gets paid first. Then next comes the preferred equity, gets paid next, and then comes your regular equity. Is that how that works?
Yeah, that's exactly right. So, the common equity debt, the common equity holders, for example, might not get any cash flow. They certainly won't until the debt and the preferred equity is paid. And that makes you wonder, well, why would I want to be a common equity holder in this deal? Well, that's something we should talk about. I told you there's some risks.
Right. And let's talk also about the lenders now. 2 years ago, they were offering, 75% LTV loan to value. And now, what you were saying is 50, 55, and 60% is more common. Why the reduction? I know the interest rates went way up, everything's uncertain, but the banks, the lenders, they can lend however much they want, right? Interest rates are higher. Why aren't they lending up to 90%?
Yeah, that's funny. Great question. The lender could do that, but they're constrained by the debt service coverage ratio. And the debt service coverage ratio is the net operating income divided by the debt service, and it's typically calculated on a monthly basis. So if the debt payments, that's principal and interest, are $10,000, and the total operating income for that month is $13,000, that's a 1.3 or 1.3x debt coverage ratio or debt service coverage ratio. That's a 30% margin of safety. But now let's say in that same deal, the interest rate shot up, and now the interest, debt, and principal and interest payments are $13,000, but the income's still $13,000. Well, that's a 1.0 coverage or debt coverage ratio. That's not safe, because if anything goes wrong at all, like reduced occupancy, reduced rents, higher insurance policy, that bank all of a sudden, I don't see how they're going to get paid unless somebody comes out of pocket. So that debt service coverage ratio causes the lender to go, okay, we're not going to loan as much, we're going to loan less. And of course, there's other reasons, like they would rather be less on the hook when things are going south.
Okay, so I'm an LP, right? So I'm typically investing in just the common equity, right?
Yeah.
So to me, there's still 75%, right, is the number that is still getting paid before I get paid, right? Because the preferred equity just is senior to me, just like the regular debt is. So is it important for an LP to know that there's preferred equity, to understand the terms of the preferred equity? Or do I just say, it doesn't matter because I'm still in the 25% and everybody else is ahead of me, whether it's a bank or preferred equity, who cares?
That's a really good question. So think about it. If it was just a bank at 75% LTV, let's say that asset was $10 million. And the bank under the old situation, the bank loaned $7.5 million, and now there's $2.5 million in equity. Okay, fine. If that goes up to a value of $15 million, okay, then the bank gets paid off $7.5. Now my $2.5 million in equity just tripled to 2.5 plus 5, so $7.5 million. But if there's preferred equity in there, and I'm hoping I can do this on the fly without making a fool of myself. Let's say there's 50% debt and there's 25% preferred equity and 25% common. Now the preferred equity is going to get a piece of that profit. So without going into all the numbers, you're not going to triple your money anymore because the preferred equity is going to get a lot bigger chunk than the debt would have in the old example. The problem is if the asset value falls, honestly, under either scenario, if you're at 75% debt or 75% debt plus equity, if the asset value falls by 25%, the common equity's wiped out.
So the preferred, the LP in the common equity, right, the typical LP in this situation, when there's preferred equity included, the downside is the same and the upside is significantly reduced from as compared to when it's just debt and no preferred equity.
Yes, that's true in most cases. And my compliance person would love for me to say in most cases, because there's probably exceptions that I'm not thinking of. But think about this. If the lender would have come in that same second deal and said, okay, we're only going to loan you $5 million of the 10, if I went out as the operator and got $5 million in equity and that went up by $5 million, well, it only doubled the money. I know it sounds ridiculous because that's great, but right. It triples the money if they're only, there's only 2.25% equity. And so it's the same with this. It's probably better than if they brought in 50% debt and 50% equity. In other words, the less percentage equity there is, in a rising value, you're leveraging your profit. And so there is a potential upside. And so all this boils down to this. If you're an LP, and I know that's who I'm speaking to here, LP investors, check it out carefully. Check out the track record of the operator. Check out the value add. Go fly down there or drive and see it. Really check it out yourself and really see if you believe the story of why this is going to go up in value from, let's say, 10 to 15 million in my example. Because if it's not going to go up in value a lot, you may want to, second guess whether you should invest as an LP in this.
Okay, so you talked about pref equity gets a monthly return plus some upside. Are there other types and structures? Like, is all pref equity the same? This is pref equity. Okay, I know exactly what that is, or is it different with each deal?
Yeah, so there's different types of arrangements. It's all negotiable. It's sort of like, that constitutional provision that says, the Constitution says any contract is valid unless it's, with an underage person or an inebriated person or whatever those rules are. But that was supposed to be funny, but I'm not laughing. Anyway, I'm not drunk though. Don't get me wrong. No, okay. Cut that. Please delete that. Okay. No, seriously. In all seriousness, we can negotiate anything we want. So as a pref equity provider or recipient, I can negotiate that. So we had one deal where we invested and we said, we believe in this deal, obviously, but we want some extra security. And so the owners, two brothers had $300 million in net worth, and they literally signed a personal guarantee on the deal. So while we didn't get a lien, I kind of feel like the, personal guarantee, and we verified their net worth independently. It was pretty good. So we can negotiate anything we want. As far as there being different kinds of pref equity, I really want listeners to hear this. If you're going to invest in pref equity, there's development pref equity. And that means, hey, I get a 20% return, 12% cash flow, or maybe it'd be more like 8% cash flow and 12% upside. Okay, that makes sense. But do you really believe in this developer, their track record, their team, their geography, and that they're going to be able to sell it? Even if cap rates go up and rents go down, are they going to be able to sell it for a huge profit? Well, a lot of developers do, and that's why they can afford this. I talked to a developer who's like, I'm making 40, 50% profit, so it's easy for me to pay 20% for a small chunk of pref equity. A second type is value add acquisition. So we've got development and value add acquisition. And that's the type I like because, these folks have track records. I could tell you several stories about investing pref equity in deals that have a tremendous amount of upside. Let's say it's a self-storage facility that's just so poorly run that there's homeless people living in it. The rates are only 41% of the market rate. This is a true story, as you can tell. There's no marketing or website. There's room for expansion and all these things. Well, you can see that thing has a tremendous upside. And so I feel pretty good about it as being of course, if there's a great operator, and there was. So I feel really good as an LP or a pref equity provider for that deal. And by the way, that's again a value add acquisition. The third type is what everybody out there on Twitter is screaming about right now, saying, don't do this. And that is rescue capital. Rescue capital is when the pref equity person comes in and they're trying to rescue a deal because, let's say there was floating rate debt and they've got to refinance next year or this month. And the floating rate debt has caused their debt service coverage ratio to go down from 1.3, the example I used a while ago, down to like 0.7, which is happening all the time right now. And so the pref equity person comes in and says, look, I want a piece of the upside if it goes well, but I will take over and own this asset if it goes poorly. Now think about that. As the common equity behind that pref equity, I'm hating that. As the GP, well, I'm not saying they're all thinking this way, but I'm hearing on Twitter and a lot of people saying, look, somebody says, I don't want to have a reputational risk of doing a capital call. I'll just insert pref equity in here kind of quietly. And I mean, so you got to wonder, for those, if I'm on the LP side of that deal, I'd have to ask myself, would I rather have a capital call and have the choice of putting the money in? Or would I rather have pref equity just put in front of me? I think I'd rather have the choice and have the capital call. What do you think?
I guess my question on that would be, is that all in the contract, the PPM and everything ahead of time? Or is this, like, if we're talking about deals that are already underway, then as an LP, I don't have a choice, right? I mean, there's nothing I could do because I have no control once the deal is done. So how do I say, hey, no, I don't want that pref equity. I'd prefer a capital call when, I mean, is there something written in the private placement memorandum that says that we do have a choice? I guess would be my first question.
Yeah, again, that's why it's so important to read your private placement memorandums. Somebody told me that on your podcast, and I didn't hear it myself, but somebody told me yesterday that on your podcast, somebody said 90% of people don't read the PPM and 95% don't do deep dive due diligence. My friends, this is why you need to listen to my friend, Jim Pfeiffer, and go out and do the deep dive due diligence. Go out and read the PPM. Jim is trying, Jim and Chad and Steve and the whole gang, they're trying to get you to read the PPM, to take care, to go out and check it out yourself. Please do it, because this stuff doesn't seem like it's that important when the tide's rising and everybody's happy. But when the tide's going out and people are starting to swim naked, as Warren Buffett says, you don't want to be one of those, and you definitely don't want to be investing with one of those guys. So, Jim, what you're doing for the LP community in America is important. It's critical.
Yeah, and in a selfish way, I'm doing it for my own investments too, because I was never one of those guys that dug in and read the whole PPM. I would read the sections I thought were important, but we've just also got another operator in our community who did a capital call, which I understand capital calls, that happens. It's not always great, but it's not always as bad as people think. But in this capital call, it was not an option, right? You didn't have the option to be diluted. It is, you do this capital or there's penalties. And nobody had read the PPM and figured that out. And so they're just getting the capital call and they're finding out it's mandatory. And that just, accentuates. There were times when, over the last few years, you could just give somebody money and they gave you a bunch more back later, right? And you felt like maybe you didn't have to do all this due diligence. But now it was essential then, but, it was easy to paper over when you're making money. Now,
right.
You got to read every word of that. You're right. And I've had conversations where, I wasn't as great at that as I should have been. And so now I'm being a lot more careful because, and it's not always that the operators are trying to hide something from you, but maybe this is just the way they do business. And so you need to know that going in. And I would like to know that as well.
Right.
If the capital call is an option, or does the operator have the option to do preferred equity instead? I want to know about that, even if I can't do anything about it. During the deal, I want to know about that beforehand. So maybe those are questions we should start asking.
That's absolutely correct. And I'm not saying there's a right or wrong or good or bad. Just like you said, it's just good to know. And if you don't like the answer and you really know in your heart of hearts, or you have a gut feeling, your head is telling you, do the deal, double your money in 3 years again. But your heart is telling you something's wrong. Follow your gut, follow your heart, because your heart and your gut probably know something's wrong. And I don't have the science for that, but it's true over and over in investing, I've found.
Hi, this is Zach Haptonstall, CEO and co-founder of Rise 48 Equity. At Rise 48, we partner with investors like you to purchase large apartment buildings that we renovate to increase the value and create a profit margin for our investors through monthly passive cash flow distributions and profits on sale. We're a vertically integrated company specializing in the Phoenix, Arizona, and Dallas, Texas markets with over 200 plus full-time W-2 employees who are focused on making sure your investment is taken care of. To learn more about Rise 48 Equity's multifamily investments, schedule a call with me at rise48equity.com/invest.
Visor provides investors with a secure platform that displays a comprehensive view of all of their holdings on a single, holistic dashboard. From real estate syndication to private equity, crypto to traditional investments, with AI-driven, unbiased, honest insights to maximize return. Visor is your one place to rule them all. Automating performance tracking, projecting future cash flow, analyzing all your financial documents, and much more in one powerful solution, making it easy to follow the money. Sign up for a free 30-day trial now at Visor.co. And I want to ask you another question about preferred equity, because as you were explaining it, it sounded a little bit like, not totally, but a little bit like bridge debt, right? You're kind of getting this extra little investment that is not intended to be part of the entire deal. It's really just to bridge you until you get to a point where you can buy them out, speaking from the operator's perspective. So what are the dangers? And we talked a little bit about this, but as an LP, and I want to talk later, how do we get in and be part of the pref equity, because that sounds like a nice place to be. But if we're just in the common, the common equity, what are we looking out for, and how do we protect ourselves?
Yeah, if you're in the common equity, and do you mean if you've already invested or consider?
No, in a new one, because if you've already invested, you're kind of stuck.
Mm-hmm. Yeah, I mean, in the common equity realm, if pref equity is an option, you mean? Or
yeah, if you see a deal and they're saying, hey, there's going to be pref equity on this, or you see a deal and they haven't mentioned it, you got to ask about it. And then once you find out it is, what questions are you asking? What is I'm not going to be on the common equity because this pref equity is messing up the deal, or vice versa. Okay, the pref equity is there. I'm comfortable investing in the common because of.
Yeah, I think, and this is going to sound like a cop-out answer, but I think it really comes down to the operator and their track record and their ability to do what they say. How often have they done this? We've invested with a multifamily syndicator that's, to my knowledge, done 81 tax-abated deals, mostly in Texas. Well, when they come out with number 82, if every one of those 81 except one has made money, and that's a true story, I'm going to feel really comfortable that they're going to be able to do what they said, especially if they're estimating their IRRs at, let's say, 12%, but their actual IRRs are much higher. I'm going to feel really comfortable with that because I believe that operator can pull it off. Warren Buffett made a decision to invest an enormous amount of money to acquire ABC in 1996, maybe it was 89, based on a 15-minute phone call. Why? Because he knew the operator had pulled off one after the other. His name was Tom Murphy. We won't get into that now, but the point is, if you know the operator can do it and they've got a valid plan, you can trust that, hey, I think I can do this investment. It's so much more important to have a great operator than a great deal. At least that's my opinion. What do you think, Jim?
I would have agreed with you a year ago, and I still do agree with you, but I want to push back a little bit.
Okay.
Because I want to ask you, like, we have an operator that I know in our community, and I don't know the exact number. I think it was at least 30 deals. It might have been 50 deals that they did. That was their track record. They had an average annual return of 30% on those deals, and they were just crushing it, right? And they were well respected and did a great job. And this interest rate thing crushed them. And not only that, and if it had just been the increase in interest rates at the pace, and that was the problem, because they're doing all bridge debt. They were basically apartment flippers, so I get it. I understand the business plan, but they also failed to execute their business plan, interest rates aside, on some of those deals that they got into before the pandemic, before the interest rate. So those deals should have panned out. So my question is, it's a long wind up to this question, but they had the track record. They had the know, like, and trust. They had every component, right? They had done everything right, and then all of a sudden they didn't. So I know 30 or 40 deals isn't 80, but how do we get confident as LPs when we're investing in these people that we completely trust? We've met, we've gone to the properties, we've visited, we've seen them execute business plans. They've had awesome returns for a long time, and then they fail, right? How do we protect ourselves? And maybe we don't, but how do we protect ourselves? Because now a lot of people, me, you, we're saying, you got to make sure track record and experience. You got to make sure of that.
Yeah.
Well, we did, and it still didn't work.
Yep. I don't think those deals failed. Well, wait. I blew it. I wish you could delete that. What I meant to say is I don't think those assets failed. I think the deals failed. And so what I would say, at the risk of alienating your audience, is you got to look deeper than just the track record. And I know it sounds like I'm going back on what I said, but part of looking at that is their business plan. And what I have always wanted, and I've been saying this on Bigger Pockets since 2017 or 18, I've been screaming at people, do not, someday the floating rate debt's going to come back and bite you. And again, I don't want to, alienate anybody, but I would say as part of looking at their track record, I'm also going to look at their business plan and say, if you're relying on floating rate debt, that's a risk. That's a risk, especially when interest rates were so historically out of line with history. And so I think that's part of it, and I should have said that the first time. But you were right, 100% right to push back on me. Thank you.
No, and it's hard, right? Because you have to rely on the operator, right? You have to learn to know, like, and trust them. You have to look at their track record and be able to depend on that. But sometimes it's just not going to work out. So one of my lessons that I learned from that, my takeaway is, I don't want to go all in with one operator or even close to it, just like I don't want to go all in with one asset class. And we talked about that. We always talk about diversifying by asset class, by market, by operator, all these different things. Right. But you see the 30% and the 60 deals they did, and you're like, well, maybe I'll just overweight on this operator because they're really killing it. Well, you just got to tread carefully, I think. And that's, you got to look at everything.
Yeah. One thing Buffett talks about, again, is stepping over 1 foot hurdles. Another way of looking at that is stop, and I'm talking to myself now, I mean that. Stop trying to hit home runs, Paul. Stop trying to hit grand slams. Just go for singles and doubles. And if you do that, some of those will be home runs, some of them will be triples. But if you go for singles and doubles, that might look like going with a self-storage deal that has a 12% projected annual return rather than a multifamily ground-up development that has a 40% projected return. You know what I mean?
Yeah, I wrote that down because that's gold. I mean, we hear it all the time. Make sure you're just thinking about the singles and doubles and don't worry about the home runs. But then how often do we chase the home runs? And I think the change I'm going to make to my personal investing is I'm still going to chase after the home runs, but I'm going to try to hit 8 singles and then 1 home run rather than 4 singles and 4 home runs, right? So I might still put a little bit of money into that risky deal where they have bridge debt and they have all this stuff that, their track record's great, but I'm not going to put as much into it. I'm going to put more into the reliable stuff. So I think that's really great advice. And I do want to step back into preferred equity because we're kind of gotten off track on the great conversation. I love this. This is the kind of stuff I love talking about, but I don't want to lose sight of preferred equity because it sounds like a neat place to be. I'm an LP, so I just get stuffed into the common equity, right? How do I get into the preferred equity situation as a limited partner investor?
Okay, so first of all, most investors, I'm sorry to tell you, can't do these on their own. You have to be in the right place, the right time. You have to be approved by the not only the operator and their broker, but you often have to be approved by the senior lender. And if it's Fannie or Freddie, it's extremely hard to get that done. Most people don't want to invest, say, $3 to $5 million, which is kind of the minimum you'd want to be at in one deal. Talk about concentration risk. I mean, if you're a huge family office, it's one thing, but if it's an individual LP, you're probably not going to. There's a lot of due diligence involved. There's $30,000, $40,000 of legal structuring involved. We do NOI audits. We do background checks, criminal checks. We even do background checks on the lenders. I don't know if you heard about the big lender. They had the FBI raid them the other day. But we don't want to be in a deal where that's happened to them, because let's say that lender reemerges as a new lender in 10 years. We're going to do a background check on them as well. And so there's a lot involved. That didn't answer your question. What it does say is it's going to be really hard to be an individual LP in these deals. Where can you do it? Number one, you can find a preferred equity fund. Now, we don't have one, but there is, I won't name the name because I'm probably not supposed to give advice, but somebody on Bigger Pockets who's pretty well known in Bigger Pockets has a preferred equity fund. And knowing them, I'm guessing they're going to do really well with it. Second, you can find a preferred equity sidecar deal. And that would be, let's say Wellings Capital, my company, let's say we're investing $5 million in a deal, but the deal needs $10 million. Well, maybe we'll put out a sidecar and the investors can come into that sidecar to the same terms we are. That might be a way to do it. Would there be any other way to be into that? I guess the third way is what I already said would be hard, and that would be if you have a whole lot of money and you're a family office, or maybe you've got like 10 of you and you do a tribe vest model where there's 10 of you at $500,000 each and you go in for $5 million. Just make sure you have the right attorney to protect you. Those are the only three ways I can think of, Jim.
That's great. I mean, this is something that I think, number one, as LP investors, we really need to be focusing on. We're the common equity. There's all these other entities probably in the capital stack, and if preferred equities in there, we need to make sure we understand the terms and how it's set up, correct? I mean, is that the main, aside from investing in it, which you've given some great ideas for that, how does the LP evaluate this? We talked a little bit about it, but is it just making sure you understand the terms and are comfortable with them?
Yeah, I would think number one, you want to make sure again the who you're investing with. It's back to that again. Who is the operator? Who are you trusting? Like Buffett with Tom Murphy. Second, the terms of the deal. The best you can possibly analyze it. And then third, I would get a third party who's done it before, like an attorney who, pay him $1,000 to glance through or read through the PPM and say, hey, what do you see that's really good and what do you see that's concerning here? And so I know a couple $1,000 maybe even to that attorney. I know that sounds heavy, but it's sure a lot lighter than losing, $1 million or $5 million.
Yeah, absolutely. I mean, spending $1,000 to save 50 is even worth it, right? So I think that's important. And then in the offering documents and the PPM, they will explain, or they should explain, the pref equity, how it works, and that it exists, right? So, and this is something I would recommend, and maybe you tell me if you agree. When you're talking to the operator, you should also talk to them and confirm, here's how I'm understanding the pref equity. Do you agree? Is this correct?
Yeah, that's right. That's exactly right. The problem is, pref equity is not new, as I mentioned at the beginning, but it's kind of new lately. In other words, a lot of people might not even really know. You need to verify it yourself. If you're talking to an investor relations person, and again, on Twitter today, I saw a story where they were talking to the investor relations person. They had no idea, and so, yeah, make sure you verify yourself and with somebody you really trust.
Yeah, no, that's great stuff. Anything else? We're about getting to the time. So anything else on pref equity that you want to say before we wrap up with our last couple questions?
Yeah, I mean, if you really believe what I'm saying, that, that pref equity not for rescue or not for development in my mind, but for, somewhat safer, I'm not saying they're safe. My compliance person would hate if I said that. But, generally well-trodden deals like value add, deals with a clear upside story. If you really believe pref equity is a great place to be, it's probably going to be a fairly short window. One of our investors was the COO of Citadel, the world's most successful hedge fund, according to the online stuff I read about them. He's no longer with Citadel, but he said that he thinks this is going to be a very short window, because to get something that's actually theoretically lower risk and theoretically higher return, that it's so unusual that it's probably not going to last for long.
Interesting. All right. So the last question I always ask is, what is a great podcast that you like to listen to?
Oh man, can I say LFI?
You can say it. I love it, but you got to add something else too.
Okay, great. I would recommend We Study Millionaires, and they've actually got several sub-podcasts, including the Richer, Wiser, Happier podcast that's hosted by William Green. William Green wrote what I believe could be the best modern investment book, called Richer, Wiser, Happier. I'd love to see you have him on the show. And William Green wrote this book. Charlie Munger, Warren Buffett's partner, said it was he said it was an immediate classic when it came out 2 years ago. But anyway, he's got a podcast called Richer, Wiser, Happier Podcast. I really recommend that.
Awesome. That's fantastic advice. Thank you very much. And if listeners want to get in touch with you, learn more about Wellings Capital, or learn more about you, or talk pref equity, what's the best way to get in touch with you?
All right. They can get hold of me on Twitter at Paul Moore Invest, or they can go to our website. It's wellingscapital.com, and they can figure out a way to get hold of us there.
Awesome. Well, thank you very much, Paul. As always, it was great having you on. Third time's a charm. We appreciate you, and we appreciate the support that you and Wellings have given to LFI over the years.
Jim, thank you so much. It's such an honor to be here.
Investing in syndications can be a daunting task. Wiring a large sum of your hard-earned money to someone you talk to on the phone for 30 minutes can certainly be scary. How can you be confident in what you're doing? Steve Sue, one of the founders of LFI, just published a book called Avoiding Rookie Errors as a Left Field Investor, 20 Lessons Learned from 14 Years of Investing in Private Syndications. This is by far the best book I've read on syndication investing. It's an easy-to-read book, chock full of great advice from Steve's experience as a passive investor. It is a must-read. Whether you're a first-time passive investor or a veteran, go to www.leftfieldinvestors.com/books and click on the link to Avoiding Rookie Errors as a Left Field Investor. If you are a passive investor, you got to read this book. What a great conversation with Paul. I just love the dialogue and the back and forth. That was a lot of fun. One of the things that I thought was pretty cool about Paul is, he was a multifamily operator, and he recognized that he was not in the top 20% of operators. So he decided that he was going to go find those top 20 operators and make sure they were available for his clients to invest in. So I just think that's a great kind of mindset thing where you're like, hey, I can go find someone who can do this better and make more money for myself and for my partners and clients. So I just think it's a good mindset there that he had. And then the conversation about speculation versus investing, ever since I was a financial advisor, I've really thought of real estate as investing and the stock market and all that stuff as speculation. And Paul really added something, because as I said in the podcast, I'm normally thinking investing is you have a current benefit, speculation is you're just buying and hoping someone else buys it from you for more for later. But he put something else in there, is that investing is where your capital is safer relative to speculation, where your capital isn't safe at all. I think that's just a great added wrinkle in, that is it for real estate, right? Your capital seems safer. Now, it's not always going to be, but in the stock market, you're going up and down on the roller coaster. So I love that added definition. And then talking about private equity, he says debt, it's like debt as far as the returns, but it's got the equity upside. So really, if you're investing in it, if you can find spaces to do it, and Paul said it's not always that easy, but if you can find space to do it, then you're kind of getting the best of both worlds by sitting in the middle there. So I really like that. And, one of the things he said is you're an LP and you're just in common equity, you do lose some of the upside with the preferred equity being in place. So it's important to understand that, recognize it, and analyze it. And that's why it's important to read the PPM. As Paul said, I haven't always been great at that, although he said I was. I haven't been. I'm getting better. But, you really got to make sure that you're at least, at the very minimum, you're checking for those things like capital calls and where you sit in the capital stack and how all that will happen, especially now that private equity or preferred equity is becoming more common. And we talked about looking deeper than the track record, right? Because everyone says now, well, you really got to focus on track record and experience. Well, okay, but that still doesn't always save you. So you really have to look at other things, look deeper, take the time, visit if you can. There's a lot of things that you need to be doing besides just looking at the track record and saying, yep, good to go. And finally, I really loved what he's talked about, stop trying for the home run. People have been talking about this forever, but when you look at it, what he's saying is you don't need the home run on every deal. In fact, as Paul and I talked, you don't need the home run on hardly any deals. Just go for the singles and doubles, you'll be fine. And if you need a little bit extra risk in your life, fine, go for the home run every once in a while. But I think over the last few years, we were all so used to hitting a home run at every at-bat that we just don't realize that, okay, maybe you can just be a singles hitter and you'll still make the Hall of Fame. All right, that's all for the baseball references, but what else do you expect? We are left field investors. So again, love talking to Paul. I think that it was going to be a great episode. I'm definitely going to listen to it again because Paul has all kinds of wisdom to share with us, so we appreciate him. That's all we have for this time. We'll catch you next time in the left field. Thanks for hanging out in the left field with us today. If you are interested in becoming a left fielder, you can find us on the World Wide Web at www.unravel.com. shop.leftfieldinvestor.com and click the subscribe button to join our community. If you enjoyed the podcast, please subscribe to the show on your podcast player so you don't miss an episode. If you really enjoyed the show, a review on Apple Podcasts or wherever you listen to podcasts would be appreciated.
This show is for entertainment purposes only. Nothing said on the show should be considered financial advice. Before making any decisions, consult a professional. This show is copyrighted by Passive Investing from Left Field and Left Field Investors. Written permissions must be granted before syndication or rebroadcasting.